Good day, everyone, and welcome to our webinar for October 2021. We'll begin as we usually do in America. And there, as you can see on your screen, the S&P is in a correction. It has fallen about 5.5% since its high of 4537 made on the 2nd of September. So it's fallen 249 points roughly over 20 days. And made an intraday low of 4288 on the 29th of September. That's over 20 days. And the reasons for this correction, which are various different reasons. First of all, the tapering. The Federal Reserve Bank in America is talking about starting tapering, which means they will reduce their quantitative easing from about $120 billion a month, starting probably later on this year. That's what they're indicating anyway. And of course, that has made the markets quite nervous because the economy is obviously being hugely supported by this $120 billion of extra cash that it's getting every month. Then, of course, we've had the Evergrande crisis, where this is a property company in China. But Evergrande is about 1/3 of the size that Lehman Brothers was in 2008. And so it's quite a lot smaller, and the Chinese government has been responding very aggressively to prevent any kind of contagion or meltdown from this event. So we don't think it'll last very long. Then the yield on the 10-year US Treasury bill has climbed to above 1.5%. You may recall that a little while ago it was just around 0.5%. And in America, the bond market and the stock market are sort of interchangeable. Investors switch from the one to the other depending on risks and perceived risks and returns. And so that rise to 1.5% has made the bond market more attractive than the stock market, at least for some investors who are busy switching out. So that's also part of the reason that the correction is taking place. And then, of course, the U.S. government is having its usual budget crisis, and they're running out of money, and they have to get approval, bilateral approval, to extend the size of the U.S. Borrowing capability. This is a fairly regular event, comes up every now and then. Usually it's resolved without any major problems, but in this case there seem to be a few headaches, so that has also unnerved the markets a little bit. And then of course, Joe Biden, the president in America, is trying to get two enormous bills through the Senate. They're both for huge spending programs. One is for $1.2 trillion. The other one is for $3.5 trillion. And investors are not quite sure whether those bills will pass through the Senate or not. And this has created some uncertainty. All of this, of course, has also pushed the market and international investors towards a risk-off position. So they don't want to take risks. They're keen to buy their treasury bills, which are the safest investments, and they're getting out of risky things like emerging markets. And of course, that includes South Africa. In fact, principally, it is South Africa. Whenever there's a shift from risk on to risk off, you're going to see the rand fall. And that is what has been happening. And we'll talk a bit more about that later. But here you can see the chart. You can see the record high. I'm pointing to it now with my mouse. There at 4537. Then we had an initial 4% drop. And then there was a surprising little rally here. And you'll notice that it came back to the support level at 4353, around about there. So it came back down to that support level, which was supported again the next day, and then broke down. And this, I think, was on Friday. And then there was a rally which brought it back up to the level at 4353, which now, of course, became a resistance level. So I've put there a little note that says support became resistance. That quite often happens in technical analysis. And then you can see the next 2 days, which are basically, this one is Monday, that one is Tuesday. We also used that resistance level. We anchored on that resistance level, and we haven't yet broken up through it. But what I've noticed is that this downward trend on Friday there was a very convincing double bottom at the bottom of this downtrend, and it's rallied back to that resistance level at 4353. This is what I call a reluctant correction. In other words, it's relatively slow. There's a lot of talk in the market about buying the dips, and there's been a small rally, which we see here within that correction. And we need to perhaps compare that with a different correction which happened a year ago. I'm just going to run back on my chart to that correction, which happened in September last year. And here you can see in this case, the market fell over 14 days, but it didn't fall 5.5%. It fell 9.6%, and it fell very rapidly. And in that case, there was no talk of buying the dip or any such thing, and there was almost no rally within the correction. So that shows you that the correction we're in now has less legs from what I can see. And I believe that it won't last that long. It seems to have run out of steam, and I think if it carries on for much longer, the bulls are going to take control and drive the market up to a new record high. Anyway, that's what looks like happening at the moment. You see, in a bear trend, 80% of investors are negative and 20% are positive. In this correction, my sense of it is that about 55% are negative and 45% are positive. We all know that the S&P 500 is overdue for a major correction being anything between 10 and 20%. But this cannot be classed as a major correction because it's only about 5.5%. If we look at the situation from an economic point of view, the economists were predicting consumer spending at 0.6% in August, but it actually came in 0.8%, so it was considerably up on their prediction. It's a big jump from July's minus 0.1%. And of course, in America also, there's been a significant decline in COVID-19 cases. Confidence levels are high. Inflation remains high, with the private consumption expenditure at 0.3% in August, the same as in July. So there's no evidence yet of a substantial reduction in inflation, which is being predicted by the Federal Reserve Bank and by Joe Biden. We're not so convinced. We don't think that inflation will come down in America, and that sooner or later the Fed will have to do more things to contain the inflationary forces within the economy. And that, of course, will be negative for shares. But it doesn't look at this stage as if this correction is going to morph into a major correction. But, of course, we are now in October month, so anything can basically happen. But as I've said before, we believe the bulls will gradually gain the ascendancy in America, and the S&P 500 should go back up to a new record high relatively soon. All right, let's turn our attention then to South Africa, and let's begin with the political situation in this country. Our esteemed Minister of Minerals and Energy, Gwede Mantashe, has once again showed that he's part of the problem. He's got a new plan to build a 2,500 megawatt nuclear plant. This is not in the IRP, and nuclear power has been shown to be much more expensive than renewables, and it takes longer to build. So this doesn't seem to make any sense to me at all. And it looks more and more like another excuse to have a major government spend, which will involve corruption and delays in a very similar way to Medupi and Kusuli. Of course, the CEO of Eskom, Andries de Ruyter, has proposed that Eskom spend about 106 billion building renewable energy sources to replace coal. And he is seeking concessional financing from a group of first world countries, including the UK, France, Germany, the United States, who are all in this country to assess the situation. This, of course, will need Treasury's approval, but it seems like they are going to have to do this. And that will be a big boon for this country, because it will result in the closure of 9 of our coal-fired power stations, and their replacement with renewable energies, probably mostly solar and wind energy. All right, let's think about the election, which is obviously coming up fairly soon. The ANC's late registration was allowed, but no postponement of the elections was considered. The ANC is evidently in disarray after Magashula's time as secretary. And the big question is arising, how can they govern the country if they can't organize themselves? If their finances are in a mess, how can they organize the finances of the country? These are good questions, and they are questions the ANC has to answer. At their recent Lekgotla, the basic income grant found considerable support within the ANC. This will be another major cost for the government, and it will provide support for the poorest of the poor in this country, people without jobs. Of course, this just energy transition, which they talk about now, where the switch from coal-fired power stations to renewable energy, but in such a way that nobody loses their job. But it does seem as if Ramaphosa is backing De Ruyter's suggestion that we obtain this concessional financing from the first world countries. Ibrahim Patel is obsessed with the wage gap in South Africa now, in top South African companies. The wage gap is the gap between what the CEO earns in a company and what the lowest paid employee in the company earns. And in South Africa, that gap is pretty big. But top CEOs in South Africa are earning around 24 million rand a year, about 2 million rand a month, and that's about 6 times what the president earns in this country. But it's on a par with the international level of salaries for such executives. So the danger of changing the Companies Act so that companies must disclose the size of the wage gap between the lowest and highest paid employees is that it might cause some of these top executives to leave South Africa. And of course, they're eminently capable of doing that. And that, of course, would result in less jobs and a less dynamic economy. Our new finance minister, Enoch Godongwana, is, I can only say, making the right noises. He's suddenly talked about increased productivity within the South African economy. Productivity, of course, is vital in this country. It is what makes us competitive in world markets. Everything else, including economic upliftment and jobs, depends on our productivity. And Godongwana is the first ANC official to mention productivity in 28 years that they've been in power. So I'm quite encouraged by that. He's also said that we must improve the environment for business. That's easy to say, of course, but what does he actually mean? That we don't know. And then he talks about structural transformation. Over the past few years, the structural transformation has come to mean a lot of things, but principally it means reducing the power of the union movement and the dominance of unions in South Africa. Personally, I think it's an indictment on the ANC that manufacturing is now only 12% of GDP. And before the ANC took power, it was 22% of GDP. So the manufacturing sector has taken a pounding under their rule. Let's look at the economy now. Old Mutual is predicting that GDP will grow by 5.5% this year. And that's pretty impressive. It's certainly somewhat up on previous predictions. The Reserve Bank and Fitch have now adjusted their estimates for growth this year up to 5.3%. And it shows that the recovery in our economy is better than expected, which is more or less what we predicted. The underutilized capacity within the economy is being taken up now, the slack in the economy. And it should begin to have an impact on the unemployment level. Of course, the civil unrest in July was a setback, but it will not be a major factor in GDP growth this year. GDP is not yet at 2019 levels, however. The Monetary Policy Committee has held rates steady at 3.5%, but their model anticipates that rates could go up in November. I personally don't think that they will, because the economy is still in distress, but it is a fact that economies around the world, especially in first world countries, are becoming more hawkish. The US is set to begin tapering by year end, possibly. Our Governor of the Reserve Bank, Mr. Kanyago, says that the inflation target should be reduced to between 3 and 4% from its current level of between 3 and 6%. He says that inflation targeting in South Africa has enabled South Africa to have exceptionally low inflation. And this has enabled the Reserve Bank to reduce rates to help the economy recover from COVID-19. Targeting has been in force for 21 years and has sustained this economy right through the Zuma years. Of course, a big factor in the economy at the moment is the commodity boom, which we could say has essentially saved the South African economy. Exports were up 50% in the first half of 2021 and 46% above 2019 levels. The trade surplus was 250 billion rand compared with 55 billion rand last year. Exports were impacted, of course, by disruptions at Transnet, vandalism and cable theft, which I'll talk a little bit more about in due course. We expect the commodity boom to continue as the world economy booms, and this can be seen from the price pattern of North Sea Brent oil. So let's just take a look at that chart quickly. Okay, I'm just getting the Brent chart. I'll put 2 years data on here, and you can see that North Sea Brent oil, having made a low down here, actually below $20 a barrel, at about $18 a barrel in April last year, has been on a steady upward trend since then. And it's oscillating between an upper and lower channel line. It came down recently and touched the lower channel line before bouncing off it, and currently oil is sitting at about $83 a barrel. So this shows that the world economy is recovering strongly. And I think that recovery bodes well for this country because we are exporters of raw materials. The trade surplus impacts on the strength of the rand directly. And the trade surplus in June month was an amazing 58 billion rand. And in the 5 months from March to August this year, the receiver of revenue managed to collect about 70 billion rand more than was in the budget, the February budget. A substantial proportion of that, of course, came from the mining companies. Some of it has already been spent. About 32.85 billion has been spent on relief after the civil unrest. But even despite that, the boom in commodities should result in the government being able to reduce debt by about 80 billion rand this year. The reduction of debt is euphemistically called fiscal rebalancing. And of course, the rebasing of gross domestic product has increased the size of the economy by 11%, and that's helped quite a lot. The midterm budget policy statement will be delivered at the end of November, just after the elections, notably, and that will be very interesting, but it should show some significant surpluses of revenue collected and reduction in the debt levels. July retail sales were down by 0.8%. They were expected to grow 3.3%, but obviously that is the impact of civil unrest. And month-to-month sales from June to July were down 11.2%. So it did have a big impact, but only for that 1 month. The unrest appears to have been a once-off event and unlikely to be repeated, which is a great cause for relief. But it has caused a loss of confidence in this country, mostly by overseas investors, and will probably impact on foreign direct investment. The National Union of Metal and Mining Workers in South Africa is starting a strike at the moment in the mining, automotive, steel and construction sectors. The industry is offering 4.4% wage increase. They are demanding 8%, and they're off on a strike now. We think that the gap between these two is not too great, and the strike should be resolved relatively quickly, hopefully. After COVID-19, these industries are still trying to recover. The union movement also has been weakened by very high unemployment levels. And also there was a recent agreement reached with the unions representing the 257 municipalities in South Africa, for an increase of 3.5%, which is below the inflation rate. So I'm quite hopeful that this strike action will not really amount to a great deal. Finally, on the economics front, the appointment of Duncan Peterson as head of assets and liabilities management at Treasury shows that this government is willing to put competence ahead of BEE considerations, and they are prepared to use the skills and expertise which is available to them. That will improve the effectiveness and efficiency of the economy over time. Right, let's consider the Rand. I'm just going to go to a Rand chart now. Have a look at that. The Rand, of course, is very important for investors because most of our blue chip shares have a greater or lesser Rand exposure. I'm just going to think, yeah, that's the chart I want. And you can see here that the Rand is in a long-term strengthening pattern, right? There's the spike where the Rand weakened initially during COVID in March, April last year, but since then it's been strengthening fairly consistently. The cycle low was at 1343, made on the 4th of June 2021. Since then we've had a bout of risk on, which was followed by the civil unrest, then the reshuffle of cabinet. After that, the Rand started to strengthen again, and then we had another bout of risk on. So the current weakness in the Rand is not caused by anything internal in South Africa. It's caused by a shift to risk on. The same factors which are in fact causing the S&P 500 to fall are causing the Rand to be weak at this stage. In our view, as you probably know, we think that the Rand is undervalued against first world currencies and that it should gradually strengthen, especially if sentiment moves back towards risk on, which I think it will do fairly soon. Most blue chip shares do have some Rand hedge element, and when you're investing, it's very important to have a view on the Rand and also to have an understanding of what sort of exposure the company you're looking at has to the Rand, because that can be a major factor. All right, just a quick look at COVID-19. South Africa has moved out of the third wave of the pandemic. We're now all concerned and worried about a fourth wave. The level of vaccinations is improving steadily, if a little slowly. If there is a fourth wave, its impact should be much less than the third wave because of the vaccinations that have already taken place here. It looks almost certain that South Africa will move towards some sort of vaccination passport, and that will become a reality in due course, as it has in other countries around the world. Discovery and Sanlam have said that they will insist that their employees be vaccinated from the beginning of next year. And I see that Pete Mouton put an open letter out about vaccinations, encouraging people to get vaccinated. I think that the most listed companies will probably insist that their employees, at least those ones that go to an office, have been vaccinated. Shops and other public places will begin to refuse entry without that vaccination passport, and life will become increasingly difficult for those people who are anti-vax. All right, let's look at the market, at the individual shares and sectors. I just want to have a little bit of discussion about the construction sector. The Afrimat Construction Index shows a 55% improvement in activity in the second quarter, but it does remain 7% below 2019 levels. It is, however, quite clear that it's recovering very quickly. Some of the companies are benefiting from the repair and reconstruction following the civil unrest. And there's also been quite a lot of new work coming from the mining industry, which of course is experiencing a commodity boom. So construction looks like it's definitely worth your attention. And here I would draw your attention again to Avenge, which is trading between 4 and 5 cents at the moment. I think this share will go up quite far from there. Its most recent headline earnings per share were 2 cents, which puts it on a PE of between 2 and 2.5, which quite frankly is very cheap. Okay, let's talk about Mustec. Mustec, of course, is South Africa's largest assembler of personal computers, well known for the Mercer brand. Okay, I just want to show you here, it's in a strong upward trend, as you can see from the chart there. This is a company which seems to trade consistently below its net asset value. It's benefiting from the fibre to the home movement, and its results for the year to the 30th of June 2021 saw revenue up 25.6% and headline earnings per share up a whopping 247%. It's sitting on a price-earnings ratio of 3, which seems ridiculous, and a dividend yield of 5.4%. To us, it looks like a bargain. So that's Mustek. ARK Invest. This, of course, is an investment holding company. The share trades at about 60% of the value of the investments which it holds. The current CEO says that they are in the process of reducing the number of investments they've got from 47 to 30, which will no doubt involve a considerable release of shareholder value. This company, by the way, owns the newly formed Time Bank, which is gaining a huge client base very rapidly. Technically, it's in an upward trend, having performed what's called a saucer bottom over here, you can see on the chart. And we think that on a PE of 5.4, with a net asset of value of 885 cents versus a share price of 370, it looks cheap. It's trading at less than half of its net asset value. Okay, the next share I want to look at is Telcom. We have talked about Telcom before, but I think it's worth an update. We've been punting Telcom for some time. As you can see here, Telcom began falling in July of 2019, and we suggested when it did that, we said you should put a 65-day simple moving average on and wait for it to break up through that. The share price came right down very sharply and then formed an island at the bottom here, and then it's broken up through that moving average, giving an initial buy signal over here in June last year, on the 2nd of June at 2187 cents, 21 Rand 87. And then it gave a second buy signal over here in October. And then it broke through the resistance. You can see this resistance level at 37 Rand. And then it broke up through that, and then the resistance became support, as it often does. And you can see it's come down and touched that support level twice, and now it's breaking up again. Since the first buy signal, it's gone up 114% in 15 months. So it's been a good investment generally. Now they're talking about listing their towers division or their property division as SwiftNet on the JSE before the end of this year. That should release further shareholder value and looks pretty good to us. Okay, the next share I want to look at is City Lodge. This is a share which has taken a real pounding because of COVID-19. Here you can see the pounding. It came down over there hugely, and there's COVID-19, and it's fallen down. Then they had to do a very bad rights issue at a very bad point, and that was very dilutive. And the share reached a bottom over here, but now it's starting to tick up. And we suggest that this share has hotels which are worth about 10 Rand 50 per share, and yet the share is trading for a much lower price. If we just zoom out there, you can see the share is trading now for about half that amount at about 5 Rand, just below 5 Rand. So that makes it interesting to us. And the important thing here is the management. This is a company whose turnover halved. There's not many companies that I know of that could have their turnover halve and still survive, but this is one of them. Business travelers are returning, and of course South Africa is probably about to be taken off the UK red list, which will make this share far more attractive. All right, let's look at another share, Grand Parade. Grand Parade is a company that used to have a lot of interest in the food business. They've now sold off most of those interests. They sold off Dunkin' Donut, they sold off Baskin Robbins, they've sold off Burger King, and they're getting out of the food business. The share price fell from a high of over 750 cents in October 2014, right down to a low of about 190 cents. We suggested that you wait for a break up through the long-term downward trend line. There you can see the long-term downward trend line. That upside break came in September, October of last year, and it came at probably about 190 cents. The share is now trading for 301 cents. So it's gone up by about 58% over that year period, and would have been a great investment if you'd taken advantage of that idea. Then I'd like to talk about Bidcorp. Bidcorp is one of the huge blue chip shares on the JSE. It is a big international company. And here you can see the impact of COVID-19 on it. This is a company which does business in 34 different countries around the world. It is primarily a food company. About 95% of its income comes from outside South Africa, so it's a rand hedge share of note. And of course, it was spun out of Bidvest in June of 2017 to release shareholder value. In its results for the year to the 30th of June 2021, the company's headline earnings per share jumped 21.8%. Technically, it's in a strong upward trend after the impact of COVID-19, and it should continue to perform well. So it's a share that we draw your attention to. The last share I want to talk about today is Capitec, and this has long been one of our favorite shares. You may recall that we bought it in our company's investment club portfolio a while back. And you can see here, there's the impact of COVID-19. It formed this island after that, and since then it's been a strong upward trend. At the moment, it's come back to touch that trend line, right? So if you are interested in this share, this is the time probably to buy it. It's a share that everybody in South Africa should hold. In its results for the period to the 31st of August 2021, its net asset value climbed by 22%. It's now the biggest share in South Africa by customer numbers. It's got 16.8 million customers. And we think that it's the kind of share you want to accumulate on weakness. Well, folks, that's about all we have for you today, and I hope that you found something there of interest and of value. And I'll talk to you again in a month's time on the first Wednesday of November. Until then, have some good investing.